So today we are going to answer a great question we recently received around the topic of policy loans. And the question is, when I take a policy loan and repay it, does the interest go back to my policy or does it go to the insurance company? The short answer is anytime that you take a policy loan, whatever the loan interest rate is, say it's 5%, that interest goes to the insurance company. It does not come back to ourselves or back to our policy. Now, why there is confusion around this is due to phrases like this: pay yourself back, pay the interest to yourself. Sometimes we hear the phrase charge yourself extra interest and pay it back to your policy. And this has to do with concepts such as infinite banking, bank on yourself, which really involve using a whole life insurance policy as a financing tool. When I borrow against the policy, my money continues to compound. But those concepts specifically, those banking concepts involve when you take that loan out, pay yourself back, pay the policy loan, and then they'll often promote add additional funds into PUAs on top of the loan. We're going to break that down a little bit further. So whenever we hear pay the interest to yourself, that does not mean that the loan interest rate associated with the policy is going back to yourself as well. So anytime we see these phrases, pay yourself the interest, for example, if you've ever seen a phrase or something similar to that, what that is referring to is just adding more funds into PUAs, dumping more money into the policy and accelerating the cash value growth. And one thing I like to make as transparent as possible here is we can do that with a policy regardless if we have a loan outstanding or not. A lot of times people look at these models and say, okay, I want to see what it looks like if I borrow, repay, then pay some extra interest, additional PUAs into the policy, and then they look at it and say, wait a minute, can I just dump extra PUAs in whenever I want, depending on the company flexibility and such? The answer is yes, and like, well, I'll just do that. I'll just max it out from the get-go. But it always depends on the individual and what they want to do. So we're going to go through some models and actually look at this as well, just to provide some clarity. But what I want to start with here is when it comes to policy loans, when you take a loan against your life insurance policy, when you borrow against it, there's going to be loan interest that will every single time go to the insurance company. However, there is still a dividend credited on any money in cash value and your entire loan balance. So for example, if I have a policy with a 6% dividend rate and I have $100,000 in cash value and I don't touch it, so you just let it sit and grow, you're going to earn that 6% dividend on the $100,000 in cash value. Keep in mind that dividend is a gross rate. We've got other content on that. Now, with that said, if you elect to borrow 50% of your cash value, so you say, okay, I've got $100,000, I'm going to loan out $50,000. I'm going to borrow against the policy. If my cost to borrow is 5%, 5% of $50,000 is what? It's about $2,500. That would go to the insurance company. I've got $50,000 remaining in cash value. Think of it this way, remaining equity in the policy. Now, the insurance company is still going to pay you dividends, that 6% dividend rate or whatever the dividend rate is on your entire $100,000 as if you never touched it in the first place. Now, if you want to get very technical, if you have a non-direct or direct recognition policy, that will have a slight impact. But regardless of it being non-direct or direct recognition, you will still see dividends paid on the entire cash value balance as if you never touched it in the first place, continues to compound. Cash value and loan continue to appreciate. So here's what I want to touch on. This phrase, extra interest. If you say, okay, I want to practice one of these banking concepts that I see in the different literature and different books out there. I want to practice this concept just like I see it, meaning I want to treat my policy as if it were a lender. Instead of me going to a third-party lender and paying them interest, I want this policy to function like that. So, as an example, if you're going to take a loan, we could take this example of $50,000, and you want to pay yourself back 10%. What this means is if you're paying yourself back 10%, that's what you're going to charge yourself. 5% would go to the insurance company or whatever the loan interest rate is with the insurance company. Then the additional 5% would go into PUAs, another $2,500 in this particular example. We're going to look at a scenario shortly here with actual numbers and actual policies, but this provides a nice overview. So here's how people often approach it. If I were to borrow from a bank, I'm going to a bank or a lender, whoever, I'm going to get money from them. Let's say you're a bank, you're going to charge me interest. If you're really nice, maybe you won't charge me anything. Now, you're going to charge me interest. That's how you make money. So instead, now I can build this policy up and pretend that my policy is the lender. Of course, I need to capitalize it first by pumping money into it. It'll continue to compound over time. But that is really how this concept works. And we're going to look at numbers in a second here, but it really involves, hey, let me build up this cash value. And then once it's large enough, now I can go to this as my source of financing for whatever it might be. If I want to buy a car, invest in real estate, provide capital to my business, depends on my situation. But I'm pretending the policy is my lender. I go there for financing, not to a bank or third-party lender. Now, as I kind of touched on earlier, some feel that this is complicated. And when they really look at the numbers, they say, okay, like I can just borrow from a policy and pay it back at my discretion, and I don't have to pay extra interest because I can just dump money into PUAs anytime I want. I don't have to have a loan outstanding to do all of this. So it's good to be aware of that. Everyone's different, of course, it depends on our situation, but let's take a look at an example here. What we're going to look at first is a policy where first I just stuff it, let it sit and grow, borrow and repay. That way you can see the exact impact that loans have on the policy, and then transition to a second model, which is the exact same policy, exact same loan model, but now we're going to charge ourselves extra interest and kind of practice this model right here. So let's have some fun. What we've got first. On the left, a policy on a 45-year-old male with a $5,000 base premium and a $50,000 MEC limit. How much is he paying in per year? $40,000 per year. So he has deliberately built in additional window room. He can pay in another $10K per year if he chooses to do so, but he's paying in $40,000 per year with a $5K base premium. So he's got some additional space. He's not max funding this from the get-go. Break-even point, clean year 5 in this example. So still not bad because we've got a heavy PUA allocation going in. By year 5, I've paid in $200,000. I have $200,000. Now, let's look at the loan model. Everything's identical here. Before I progress on, keep in mind, or just pay attention to those columns, those annual dividend columns. We pulled these directly from the life insurance illustrations. So there's your premium and PUA payments, annual loan. We borrow out $150,000. We borrow against the policy here. What is the impact that that $150,000 has on your life insurance policy? That's what I want to know if I'm using this as a means of financing, or if I'm ever going to take a loan from the policy. How does it impact my money? My cash value is your equity, the gauge that determines how much you can borrow against the policy. Death benefit, what do you notice there? The example where you didn't touch it, your death benefit is 1.465. What's 1.465 minus 150? Look at that, 1.315 to the penny. It's identical. Anytime you take a loan against a life insurance policy, what will happen is you will see that your death benefit is collateralized dollar for dollar. So really, that is how and why insurance companies continue to pay you dividends on any money in cash value and what's outstanding in loans. So for example, you take that loan out in policy year 5, your dividend here, $35.60. What's it over here? $35.60. How about the next year? $44.16, $44.16. The cash values are different when you look at those. And the reason why is you've taken this loan against the policy. Now, we can pay back loans however and whenever we want. We've got other videos that really provide more transparency on that. But in this example, we pay it back rather aggressively. Loan repay, $40,000 per year. And if you tally up those payments, you got 40, 80, 120, 160. Let's just round up. to just about 170 in total payments. You loaned $150,000, which means what? $20,000 was interest that went to the insurance company, not back to myself. So if I stop there, this might not make that much sense. Just as I look at it on paper saying, wait a minute, I'm paying that interest to the insurance company. Am I paying interest on my own money? Well, I borrowed against it. Interest is going to the company. However, look at this. When your loan's paid back, what do you notice? Cash value and death benefit are 100% restored to exactly what they would have been as if you never touched it in the first place. So things just kept on compounding. Think of it this way. If this was an appreciating piece of real estate, appreciating at 5% per year, and you borrow against it, you take a line of credit against it, the fair market value continues to appreciate at 5%. So when you eventually pay that loan back, you see, hey, if I sell it now, I've still earned the appreciation on the entire asset, my entire piece of real estate, not just the remaining equity I had in the policy. The trade-off, or the difference with a life insurance policy, circling back to the death benefit, is if I die with a loan outstanding, there is a lesser death benefit paid to my beneficiaries. Some people are concerned about that. Some people tell us, I don't care, it's still sizable. Always depends on the individual. And this does have a loan interest rate here, and it's spent a lot of time on this, of 5%, which goes where? To the insurance company. If we feel that is high, we can look at a cash value collateral loan, which will lower that. So this example displays paying back the principal only. If we go back to the whiteboard, what we did not touch on at all here is this, extra interest. So we're going to look at that next. What I really wanted to just set the foundation with, or provide a foundation for first, is what it looks like when I just borrow and repay. Do not look at any extra interest. It really helped with my understanding the first 1,000 times I went through all of this because I'm a slow learner. So let's progress on to the next piece, extra interest. So you will notice on the left, identical here, exact same policy, 5K base premium, $50,000 MEC limit, crossover point year 5, all that good stuff. As you look at the first 4 years on both models, they are identical because they're the same policy. Pulled them directly from the insurance illustration software, as we always do. Now, we take out a loan here, $150, same impact as we saw in the last example. Borrow against the cash value, or against the policy, cash value drops, death benefits collateralized. We repay it, here we go, at the $40,000 per year. We also, circle this in green, make an extra PUA payment. So this would be a model reflecting the extra interest that I want to pay back to myself or pay back to the policy. What I'm doing here is saying, okay, I took that 150 out, I put it in a piece of high-performing real estate that I can pay the interest back and another 10 grand per year. That'd be a nice return, but there we go, 10,000 per year, which technically is added to this. So what's happening here is years 6 through 10, we're actually adding a total of 50K per year, 40 in the standard payment, going back to the growth model, and then another 10K per year over here, so a total of 50. So now we're pumping more money into the policy. So now the difference will be as follows. Look at the first year you take the loan out. In respect to your dividend, still the same, $35.60. The next year there will be a difference. And the reason why is now, the following year when dividends begin to credit, so it'll be year 7 technically. The reason why is you're beginning to add more funds into PUAs. So 53.45 compared to 55.23. You've gotten more money into the policy. If we look at year 10, 91.63, 83.64. Cash value difference. Let's clear the screen here. Year 10, 468 over here. $523, where really the difference with these two policies is now you've added an additional $50,000 into PUAs, and that'll continue to compound over time. So that is really where we are charging ourselves extra interest. We're pretending, hey, if a bank was going to charge me interest that nets out to an additional $10,000 per year here when I have that loan outstanding, let's pretend that my policy is bank. I'm going to go through this exercise mentally and with my money and pay it back. And then boom, I've got more money at the end of the day. Now again, just to reiterate a point here, when it comes to these PUA payments, we do not have to have a loan outstanding to practice this, meaning we can pay it back however and whenever we want. So this can just be done anytime, it could be earlier, completely up to the policyholder. And of course, with this, if we're modeling this kind of stuff, it is important to look at some additional MEC tests, because that is one concern I have, especially long term. But that's more of an agent training piece. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. Please feel free to reach out to us anytime. We always love connecting with people, and we'll talk to you soon. Have a good one. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.